Hope everyone's doing well. This is going to be a video over July the 11th, 2022. So as you can see, here is the open of the week. And there we go. On the daily chart, we finally got let me do it like this. There we go. Daily chart finally got a close below the open. So this ends the six consecutive bull streak on the daily chart. And the odds favorite today or tomorrow, closing above the open. And let's go back to the 5-minute. So as you can see, on the open we gapped down, had a potential for a measured move target, but obviously we came close, didn't quite reach it. Typical when you have a trading range and you break below it, it's a bear breakout below a double top. Same thing if you have a trading range and you get a bull breakout, it's a bull breakout or it's a double bottom. So it's an upside breakup, a double bottom. And when you measure trading double tops and double bottoms, typically it's easier to start with the smaller target here and then start playing around with the bigger target should we get there. So on the open, we gapped down and we had really, you can call it a bear trend from the open that evolved into a triangle right here. So breakout mode, broke to the upside, testing the open of the day. And we had a second entry short, so second failed breakout of above the open of the day. You can call it a retest of these lows over here. And then we got a strong sell-off, and when we got this, the odds are we were going to get a second leg down, which was here. And really, one last thing to mention on the daily chart, this was so strong that the odds were the Bears were realistically going to be limited in what they could do today. So the real objective the Bears had was closing below the open of the day, which I have labeled as the open of the week, but obviously it was the open of the day today since it's Monday. So just kind of take it bar by bar here. Do something like that. There we go. So first bar of the day, doji bar, tried to close on its high, but big gap down, big bar, big risk, and obviously closed below its midpoint, so probably going at least a little bit lower, but probably buyers below. Strong bear bar, strong enough surprise that probably at least second leg down. May not be always in short yet because you may get a big bull bar closing up here, which would be enough to reverse this bear bar. So, if you got something bear breakout, if we got something like a big bull bar, if this was the low and this was the high, similar to that might be enough to shake the bears out, but probably a strong enough surprise. Bulls are going to be hesitant to sell. Doji bar, so probably sellers above, probably sell the close, betting on at least second leg down. And we have a bear bar closing at its midpoint. It's a micro channel, 4 bars, probably at least second leg down. But again, this is a sign that we may find buyers soon. And another doji, it's a micro double bottom, down, up, down, up. You can also call it a micro wedge, down, up, down, up, down, up. But it's a very tight bear channel, so probably have to go sideways for a few bars. Probably sellers above, scaling in higher. And you'll have bears who sold this close disappointed. They'll probably look to get out break even, which you can see they did on the open of this bar. It went a few ticks below, turned up. One thing that was interesting here, traders that sold, if they tried to sell, I want to say 5 points higher, 58, 75. Yeah, so you had some bears that tried to sell here and 5 points higher. They didn't get filled. And price started testing back down to this low down here. And that's one of the tricky parts about, and this is more just kind of a fun fact, you don't have to, I don't think most people should pay attention to this, but whenever you'll have a reasonable sell and then a scale in target, 5 points higher, that doesn't get filled. And the objective on the trade is you sell this high, if it goes straight down, you take a profit, or you sell this high, you scale in higher, and if you scale in higher, you can get back out at your original entry. And the math works out really well with that. And this is just kind of a general, just using this as an example. But the problem here was when you sell and you don't get filled when you're scaling, price goes back down, you have to think about the traders that did sell and scale in, and they're going to get out of break even. So it's a difficult choice because the traders that were short are now back to break even. They didn't get scale in, so do they get out of the trade, completely break even, or do they try to get 5 points on the trade in their direction? So they sell this high, 58.75, they need 53.75 to get out break even, and you can see 53.75 was the low. It didn't go there, and it actually filled them on the very next bar and turned up. But that's a lot to process with scalping, and most traders shouldn't look at that. So most traders should bear breakout, they either sell it and maybe they get out above this bar, second entry buy, possible second failed breakout of the prior day's lows. Let me just go back up a few bars. So anyways, bears would scale in, and then it really becomes a limit order market. Bulls will buy lower, strong enough, enough disappointment that some bears will be worried we won't get a new low. They'll start buying early, which means bulls will buy early, and second entry buy, but turns into a low too short. But it's a doji bar and it's a wedge. 1, 2, 3. You can call it a micro double top here, but bear bar closing on its low. But if you're selling below this bull bar or this bear bar, it's not a great trade because it's forcing you to sell low and in the middle of a trading range, and the risk reward is bad. And you can see traders sold it, some scalped out, some bought lower. Limit order market. So now the bulls have 3 consecutive. Excuse me, let me get a sip of water. So now the bulls have 3 consecutive bull bars. Probably, is it always in long? It might be. The bulls might need one more bar. It's probably strong enough though that some bulls will buy, scale in, confident that they can get out break even. But again, that can be tricky because what do you do if you get a big bear bar closing on its low? It is a wedge top, but after 3 consecutive bull bars, probably going at least a little bit higher. Doji bar, again, failing at the moving average, not ideal for the bears to sell, but it's also a sign of weakness by the bulls. It's around a 50% pullback. It's testing this low, so it's disappointing. But you'll probably, there will be bulls who will buy this close. They may buy this low, scale a little bit lower, get out break even, worst case. And you can see they did that here. So they bought this low, scaled in, and they were able to get out somewhere over here. Now the problem with that trade is this can happen. That's a very quick trade. It's a small second leg, and it's hard to manage because if it goes sideways long enough, there's a very brief window for a small second leg. So you could buy this low, scale in, 4 points lower, 5 points lower, and you could get at least 1 times your actual risk, probably more than that if you scale in. And the tricky part is, so what I mean by that is you buy this low, you buy that low, you buy this low, you scale in, and there's your actual risk. So you actually got 1 times your actual risk, even if you didn't scale in. And it'd be very difficult because you'd have to buy this low and be very quick, and then during this bar get out right here, which would be hard to do. So most traders would buy here, or just buy a few points lower, or buy here, scale in a few points lower, and be quick to get out. Big bear bar, surprise bar, probably, is it always in short? Probably. I don't know if it ever went always in long here, but you have big up, big down, probably going sideways. Is it sell to close? Might be, but again, you had a strong enough rally here, retesting these closes. You may get a small second leg down, but the bears have the same problem the bulls had here. If there's a big bear bar, we may go a little bit lower. So if there's a big bull bar, you may get a second leg up. Plus, there's a wedge bottom here, and we'll probably have to test the moving average. So the bears really need another bar, but they'll probably get it. And they didn't get it here. Now, just because I said the bears need another bar and they'll probably get it, does not mean you should sell the close. The bears need confirmation. Otherwise, it's a sell vacuum back to this trading range. Didn't get it, and the market's turning back up. So 3 consecutive bull bars, testing up here. Some bears will sell here, scale in, betting they get out break even. Some bulls will buy this close or buy this low, scale in lower, betting they can get out break even. It's trading range, and you can see it almost let them out here, turned up. So some bears sell here, scale in higher, get out. Some bulls buy here, scale in lower, get out. And no surprise, the bears that sold this high, scaled in, were able to get out. And the reality is you'll probably get down to this close. It's a limit order market, and limit order markets are very forgiving for scale in traders. And there you go. So bears sell this close, and they sell more up here, and they can get out break even over here. Bulls bought this close, they scaled in here. Even if they bought more down here, it's probably going to go back to this price level. And it did, right there. Now, I don't think that's the most ideal way to trade. I think a lot of traders would try, if they're going to be trading in a trading range, they want to buy below things. So they'll buy here, scale in lower, scalp out, buy this low, scale in, scalp out, sell above this high, scalp out. They're not necessarily, I don't know how many are buying this close. And I realize some are, but I think it's much more difficult to buy this close, hold, buy more here, and get out up here. It's easier if one can be more aware of what the buy and the sell zone is. And I wouldn't recommend that because a lot of traders, again, some traders may trade at double their position size on the scale in. So if a trader sold this close, if they sold 1 contract, they might sell 2 more contracts up here and be net 3 contracts, which would raise their break even higher. So again, most traders are better off waiting for swings, beginning to form some form of a triangle. You can call it here 1, 2, 3, 1, 2, 3. It really doesn't matter. I kind of look at it more like that. I don't know. I think the shape looks a little bit better. I know Al I think he drew it like that today. Something like that. Again, it's the same. It's a tight trading range going sideways. It's a triangle. So breakout mode, and you can see, I forgot to mention, bull bar closing on its high under the moving average. At some point, the bears aren't doing enough, and eventually the bulls may get the upside breakout. 3 consecutive bull bars. Is it strong enough for a second leg? It might be. So is it sell to close? I don't know. Not ideal to sell it to be, is it buy the close? Probably not. Not ideal to buy up here, tight trading range, and there's still around the 50-50 chance that this bull bar will fail. And then we get a bear bar, micro channel, 1, 2, 3, 4 bars, 5 bar micro channel, weak bear close. So some bulls will buy this close, scale in, buy more even, get out break even. Big bull bar, enough of a surprise, probably at least a second leg up, probably test the open of the day. So some bulls, again, they'll buy this close, scaling lower. Now, what do the bulls do if they get a big bear bar closing on its low in the next bar? Well, some bulls would get out. Other bulls would say, it's trading range day. Even if we get a big bear bar, I'll buy below it and get out break even. Now we got another big bull bar, so clearly always in long. Bulls will buy this close, stop somewhere down here. They'll be willing to buy more lower, betting on at least a couple legs up, maybe break above this high. The only problem I have is I do think we're going higher at this point. But again, my problem is the daily chart. With this many bull bars on the daily chart, the odds are today is going to be is probably going to have a bear close, if not tomorrow. So even with all this buying up here, this may just be a buy vacuum test of the open of the day. And I'll put open of the day just to ease confusion. And I'll change it to the open of the week later. Bear bar, possible second leg trap, but again, it's a micro double top, down, up, down, but Small bear bar, big bull bar is probably going up for at least second leg. And there's a second leg. There's a third leg, so it's kind of a micro wedge. Consecutive bull bars, but again, top of the trading range, testing the gap here. Bear bar, 1, 2, 3. 3 pushes up, or you can say it's a double top here and here. Bull breakout followed by a complex top or low 4. But it's also a micro channel. It's a 1, 2, 3, 4. 6 bar bull micro channel, probably sellers above. And at least a second leg, which we have it now. Then we get a bear bar. So now you have an even more defined low 4 short. We have a double top here, bull breakout, low 1, low 2. Trading ranges are also notorious for creating disappointment. So we have this lower range here. We have what could be developing an upper trading range. And we could easily test back down and fill these gaps. So traders, even traders here, they see this big bull bar, they sell the close, saying, yeah, we're probably coming back to here. I use a really wide stop. I'm not that worried. So they'll sell. And, maybe they sell one contract up over here and they wait for a bear bar. And they, maybe they sell 2 contracts below this bear bar or 2 contracts below here. And even if they just sold 1 contract here and 1 contract here, those bears are pretty confident, worst case, we're going to here. And I apologize, I had this wrong when I drew it. That's the open of the day, which furthers my belief now that if a trader sold here, sold more here, the midpoint is the open of the day, which we're probably going back below it. And that's why that tail right here was created. Price went 1 tick above the open of the day and turned down. So always in bears, bulls probably get out below this bar. 3 consecutive bear bars breaking below the open of the day. Probably at least second leg down. Is it sell to close? Probably, but a lot of traders be quick to get out. Some will sell, scaling higher, betting on the second leg. More bear bars. If you're selling closes, you have to ask yourself, what's your goal? Are you selling, betting on a measured move from the high to the low down here? Well, we're probably not going to get that. So, you're selling in the middle of the range, which isn't ideal, but it is strong enough that we're probably going to have a second leg down, which the bears got. So double top, second entry short. Can you sell below it? Maybe, but again, not really ideal. And then decent entry bar, decent follow through bar. Coming up in the final hour of the day. It's still sell to close in here, so traders will sell this close, wide stop, bigger body, so a sign that this is climactic. And the market may reverse soon, but even traders will sell this close, scaling higher, betting they get out break even worst case. So some will sell here, maybe they sold here, maybe they sell above it, confident that they can get out somewhere around this low or this close, and they got the second leg down and went sideways for a few bars, broke below the low right here, and then immediately turned up and tried to rally into the close and get close to the open of the day. So overall, limit order day, it's easy to be hopeful and hope for a bull trend, hope for a bear trend. You hope for a bull trend here, you hope for a bear trend here. And if you're not aware of what's going on, it's one thing to sell, betting that the selling is going to be limited, and you sell this close, you scalp out, you sell above bar, scalp out. But it can be very easy to get hopeful. And you can get hopeful in the reversal, you can get hopeful on the sell-off, where you have a big bear bar, follow through bar, you hope for a bear trend, and and then you reverse to long, or maybe. And I guess the point is, without kind of going on a long-winded tangent with that, the point is, trading ranges try to get traders to be hopeful, because They don't understand what's going on. This is a cell vacuum testing some sort of support level. And, for example, when a bear sees this doji bar, they're already leery. While some bulls will buy this close, confident the market will come back to it. While bears, they want to sell, but they're leery. Big bull bar. But this is such a strong move down. Why didn't it happen on this bar? If this is a strong bear bar, great. Well, I want to see traders sell more on a strong close. I want to see them take profits. Well, what happened here? If this is such a strong bear bar, why did we hesitate? Why did the bears sell, scalp out? Why couldn't they do this? This is strong. Bulls got a big bull bar, and look what happened. It went 1 or 2 ticks below and immediately raced up. Well, why did we go several ticks above and race down only to close at the open? That's a sign that, again, there's hesitation by the bulls. So I think there's going to be a second leg, but if the bears were truly, truly strong, we'd get something like this, outside down bar, up a few ticks, immediately turned down. So that's the mentality a lot of scalpers have in a trading range. And same thing here. Sake of the bull bars, but why the tail? Another big bull bar, okay. Breaking above here, still at the moving average. And, that's disappointing. Al always talks about disappointment as the hallmark of a trading range. And the reason for that is it's a radar to understand when something is disappointing. And a lot of times moves will go for a second leg and not go very much further. But anyways, we can talk more on that for another day. Hope this video helps.